Hi, so excited. Capital Races Club gets to interview Veena Jetti today with Vive Funds, and such a pleasure to have you here with us. And hey, for everybody who's watching this live right now, feel free to point in the comments where you're watching this from and where you're at so that we can get to connect with you. The more interaction, the more fun for everybody. So without further ado, Veena Jetti, welcome.
Oh, hi. Thanks for having me, Samson. I'm so excited to be here.
Me too. All right. So I know a lot about you. I've heard a lot about you and I've read a lot about you, but our audience may not know everything yet. So would you like to share with them uh, a little bit about yourself and how you got started in commercial real estate? And
Yeah, absolutely. So I'm Veena Jetti. I run a company called Vive Funds. I'm a large multifamily owner operator. So we specifically target Class B value add assets, and we really look at larger assets in our target markets. I got started. Okay, so I always tell everybody I kind of took the shortcut into real estate because I come from a real estate family. So my mom is a very successful real estate investor, and her and my dad retired early from their portfolio. So I basically took what they had done and kind of scaled it up to the next level. And so now we transact on, fairly large deals, but hopefully not the largest we'll do in our time. But I'm really excited to be here and talk to you about raising capital and all things multifamily.
super cool. We have one of our audience members, Ariel Duvernay, says
Oh,
she's in Kylie, Texas. I don't know if you already know each other. You're both in Texas, so
yeah.
uh, that's
We do
super
not
cool.
know each other yet, but I'm in Frisco, so I'm just north of Dallas.
Wow.
Not too far. Mhm.
So when you started Vive Funds, how was that? I mean, how did you get your beginning? You said you've been in real estate. You
Yeah.
come from a real estate background. So how did you decide to go commercial route and how did you start Vive Funds? Because a lot of our listeners, capital raisers, active and passive investors and operators would lo I'm sure they would love to know how you did that or the
Yeah,
beginning phase.
absolutely. So I graduated from undergrad when I was 20 years old with my degree in finance. So I thought my mom wanted me to come and work with her in the family business. And I was like, no, I'm an adult. I have a degree now. I'm going to do something totally different. So I went and I worked in commercial real estate and made a bunch of money for other people. I was at Tishman Speyer until 2012, where I paid taxes for the first time as a married person. Um, when that happened, I called my mom and said, "Hey, mom, what happened just now? Why did we pay all this money in taxes?" And she said, "Well, you should look into starting to invest for yourselves because it's very tax efficient." And I think many of us know and love that about investing in real estate. So then I ultimately left Tishman Speyer and started investing into deals for ourselves. In doing so, I had a lot of our friends ask me, like, hey, can you teach me how to do this on the weekend? And I was like, well, you work 100 hours a week at your cardiology practice. So no, because I do this 100 hours a week. This isn't like a weekend gig for me. And so then it became, okay, well, why don't you just take my money and invest where you invest, just invest it alongside of your money. So that's when I called up our SEC attorney and kind of talked about what that would look like, how we could be securities compliant. So it was actually almost an accident that we started raising capital. And then as we continue to grow and expand, we've kind of refined the process of taking in investor capital and how we talk to our investors, how we present, and then also how we distribute and just overall the user experience from the investor side.
That's so cool. And now your investors get to learn alongside with you and also gain the I mean returns that they get. So what is when you started? Oh, we have several in the chat that shouted out where they at. So hey, by the way, this is an interactive interview. When you put in questions, we will incorporate them in this interview after the first couple of questions. And with that said, um, when you started the Vive funds and when you started accepting investors to your deals, how was that transition from, you focusing on your own and then later, how was
Uh,
that?
Terrifying. There's a different level of responsibility when you're investing someone else's money instead of just your money, right? It's because I can handle if we have an issue or we don't make our returns. It's a whole different situation to have investors in the deal. So I think from the day I first accepted investor funds, I haven't slept the same because it is stressful and it's a lot of pressure. But ultimately, I think our investors have had a good experience. We really pride ourselves on building strong relationships and communicating really well with our investors. And I think that's served us very well over time.
Yeah. I I have a follow-up question. What are some of those investment criteria that make you sleep better at night?
Oh gosh, we're like ultra conservative on how we underwrite. And I know it's so funny because I say that and I'm like, okay, everybody says that. No one's like, oh, by the way, I was super aggressive in these assumptions. So it's like, one of those things we all say it, but are you actually being conservative? And so by way of example, our last two assets that we've closed in the Atlanta MSA, we are already delivering 33% above year one pro forma to our investors. And so, right,
Oh,
but it's because we conservatively underwrote it. So our investors really invest with us because they know and trust that we are going to try to over or under promise and over deliver above what our pro forma shows.
that's that's such a huge. I mean, you really yeah, you're definitely conservative when you
Yes.
promise and when you deliver. That's great. We have a question from Dustin here who's watching live on YouTube, on LinkedIn, sorry. So, as business owners, we set personal goals, and what are some of your personal goals?
Yeah. So the reason I actually do this isn't for the money. I know a lot of people kind of think that or assume that I do this because I am a mother to twin toddler girls, and there's not really a whole lot of people that look like them in these spaces. And to me, it's really important that my kids see that they don't have to choose between having a family and doing something they love, and that their gender or race shouldn't be a negative. It should be something that they embrace and utilize to play in what is historically a man's world. And so for me, that's really important. So my goal is to set an example for my kids so that they know that they too can do whatever they want. Other than that, for me, it's not so much the money isn't it. It's actually what the money gets you, which is control over your time, right? And so for me, I want to have the freedom to, well, the irony is I left corporate America because I was working a lot of hours for someone else. And now I work like 100-hour weeks are totally routine and normal. And so I'm willing to work a whole lot of hours as long as it's not for someone else. So, but I ultimately have control over my own schedule, my own time. Nobody tells me when I can and can't take off or work or go on vacation. And that's important for me, even though it means that I actually take less vacation time. So
But
double edged.
that's but you get to choose when you take those vacations. You're in control of that, so it's way
Yes,
different. I'm
yes,
sure.
yes.
Here we have uh, a lot of the questions that we usually ask our guests on the interview is we went really fast over the introduction of where you came from and how you got your start and everything. But would you like to share with the new capital raisers or the new operators in the industry? What are some do's and don'ts that you've noticed in the industry? You already said about conservative underwriting, but would you
Yeah.
like to share some other?
Yeah, I actually want to say that one again because I think it's the most important one. So when you are underwriting a deal, it is a far more pleasant conversation to have investors calling you saying, hey, I got a deposit from you and I wasn't expecting anything for 3 months. Or how did you calculate this? Because I thought it was going to be $100 less or $1,000 less. that is a very fun conversation or email to get versus the opposite. And so always everything goes back to numbers. If you don't understand your numbers, spend time in your deals, spend time understanding the math behind it and why we care about certain numbers and how they all affect each other. So that's one. Two is over communicate. When you think you're communicating enough, you probably can communicate some more. I'm always accessible to my investors, so they don't reach out to me and then I pass them off to someone else. I try to be interacting with them all the time. I make sure to reach out to them anytime anything is happening, whether it's positive, negative. I always reach out to our investors. So communication is key. And then also, I think the biggest one that a lot of people don't do, especially when they're new, is they wait for a deal to start raising capital. I don't raise capital when I have a deal on the table. I raise capital in between my deals. So right now we're in acquisition mode. We're looking for our next deal. I'm raising capital now. I'm talking to investors. I'm getting them primed and ready to go so that by the time I do have a deal, all they're doing is they're evaluating the opportunity and deciding if they want to invest or not. They've already vetted us as sponsors, our strategy. They've already made sure it aligns with their portfolio. And then they're just waiting for that deal specific details to come out.
We could just rewind what you just said and call it a day because I'm just kidding. We have more interaction in the comments and some more questions. Feel free, by the way. I would like to invite everybody who's watching this live that if you're on YouTube, if you're on Facebook, or if you're on LinkedIn right now watching, feel free to let us know that what you're looking for and what kind of questions you would have for Veena. Because hey, one short question. Currently, you're managing a lot of assets. Could we just briefly mention what kind of size are you at right now?
Yeah, so we've transacted on a little over 600 million in gross asset value to date. Now, the caveat to that is we're starting to dispose of some of our assets, so that number is starting to come back down. But across the life of my portfolio investing for myself, it's a little bit over 600 million in gross asset value.
That is insane! Holy cow! It's a different ball game. And would you say that when you scale to that size, that the same principles apply that you just shared with us? That hey, be very conservative, keep those relationships very tight, and communications clear, and also that yeah, would you say that those apply still?
Yeah, I would say they actually maybe even apply more because now you're managing hundreds of investments, not just a handful. And so now you really need to have your processes and systems in place that make sure it's a seamless experience for your investors. So everything we do, I like to describe us as investor obsessed. So everything we do, whether it is signing up for a new software, whether it's how we're going to communicate, whether it's how they sign their documents, everything we do starts and ends with how does that affect the LP and what is their experience when doing it? And so we continuously make updates and changes to our processes to reduce friction, to make it an easier process. And so I have some investors who are not tech savvy at all. They don't really use the computer all that often. I will have our team go in, pre-fill all of their document out, take information over the phone if they need to, pre-fill everything. So all our investors have to do is go click, 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 and sign after verifying that it's correctly input. So we go above and beyond to make sure that that process is a little bit easier, especially if they aren't used to using the technology that we've implemented. So I would say remain investor obsessed and have those processes in place so that you can scale. Because it's very tough to try to figure it out as you go along.
Absolutely. Hey, just another question is, what advice would you give to high income earners looking to invest in real estate? You said, you prepare most of it for them, but what could they do, and what advice would you have for them?
Yeah, so we're a high income household ourselves. So I'm actually married to a physician, and we get cold called all day long for investment opportunities. And it's really interesting to see how people underwrite deals and what assumptions that they're willing to make. But I would say if you're a high income earner and you're looking to invest passively, the first thing you should do is reach out to multiple sponsors. So get to know your sponsors. So for example, we don't do very many deals in a year. We're very patient investors. We will not do any deals if they don't meet our criteria or if we have to overpay to get them. We're very disciplined. We're very patient. So I don't put out a whole lot of deals. I have a lot of demand in my deals. My investors, 80 to 90% are in 2 or more deals with me. And so I have a lot of repeat investors. So what I would say to high income earners is, first of all, reach out to sponsors, get to know them. A lot of us will have a portal of some sort or a mailing list that you can join, and sign up for a lot of them, because there's no harm in looking at deals. You can start to kind of see trends for how often someone's doing a deal. Is someone concentrated in 12 markets, or are they concentrated in 2, 3, 5 markets? You can also look at what their typical return criteria is or investment criteria is. So if you are an investor, for example, that is looking to do a 2x on your money in 3 years, my investments are not ever going to be appealing to you, because we just are not that aggressive. And sure, we deliver it sometimes and it's happy accident when it happens, right? Or I shouldn't say accident, but it's a happy situation when it happens, but we don't project that out to investors. We don't set that expectation to investors. So know who you are as an investor and find the sponsor that aligns with you. And then you don't need to have 10 different sponsors. You need like 1, 2, maybe 3 sponsors that align with your goals and your investment criteria. So that's where I would start if I were looking to get into the passive side.
That's great advice right there. That brings me to our first sponsor shout out for today, which is this episode by Capital Raisers Club. Feel free to go to capitalraisersclub.com for more. This event is sponsored by GOB Network, where you can connect with passive and active investors and get to know more operators.
That's another good place to find these sponsors, is going to these platforms like that so that you can get to know many sponsors at once.
Yeah. How would you say that you can also network with sponsors or active operators? Where have you seen? I'm just interested, because I see a lot of them on LinkedIn. I see a lot of them on Clubhouse. I mean, they're everywhere, right? But how do you find them?
Yeah, I think it, like you said, we're on social media. A lot of us are. A lot of times it's how we connect to our LPs and our partners, people we're buying from, people we're selling to. So I think on social media, you'll find a lot of us. Some of it's harder, like it's hard to connect really on Instagram, right? But LinkedIn, Facebook, there's a lot of different Facebook groups dedicated to multifamily. I speak on Clubhouse often. I answer a lot of questions on there and try to help other people who are looking to get their deals done. So we're on social media. For me, investors, like I said, they always have access to me. A lot of people will sign up in my portal that are sponsors themselves to see when we have a new deal or how we go about what our process is through the capital raise side. So, I don't have issues with other sponsors trying to kind of see what our process is and adopting what works for them.
Yeah, everybody can learn from everybody.
Absolutely.
It's such a abundant minded industry, I would say. And
Yes.
that brings up a great question. I remember one of the times on Clubhouse when you and Alvin Hope Johnson were sharing that you have started something recently. Could you share with us what you started and how people can join it? And let's see if we can put the link here in the chat at the same time. That would be perfect.
Yes, absolutely. So Alvin Hope Johnson and I started a mastermind because we kept getting requests to help with underwriting, capital raising, OM processes. And, both of us really wanted to help other people. And we were getting the same questions over and over and over again. But obviously we both run full-time companies. So it made it a little bit more challenging to be able to help everybody we wanted to. So instead of not taking on the challenge, we actually accepted it and we created a mastermind. So we meet every 3 weeks and we help other individuals in this space figure out how to scale, or we help with everything from A to Z because we both transact on our own deals from A to Z. So It's multifamilymonopolymastermind.com. So www.multifamilymonopolymastermind.com. We meet every 3 weeks, so it's not every month. We meet about 17 to 18 times a year. And then we have 2 COVID allowing in-person events where we'll spend time together and kind of get that in-person networking. And then Alvin runs the Clubhouse Live conference. And so the Clubhouse Live conference, there's like a discount code for anybody in the mastermind. And then, we hang out when we're there too. So
That's so cool and so generous of you and Alvin to, reach out and also lift up other operators. We have the link here from Cecilia Holmer sharing on LinkedIn, multifamily monopoly to the operation. Google it. No, I'm just kidding. please text Veena Jetti. You can find out the information after the show or in the ending of this show. So we have some questions from the audience. Some really interesting ones. I saw here that there was a question from Miller Jennifer from on LinkedIn, asking with market prices increasing so much, do you feel that Vive can still deliver the same type of returns for your investors?
Yeah, so yes, we can deliver. We have been delivering the returns that we've projected to investors, but really what it is a lot of investor education, and it's a lot of resetting expectations as the market changes. So 3-4 years ago, it wasn't unusual to have an 18, 19, 20% plus IRR on deals that we would do today. Today, that's just not where the market is. Right now we are projecting out anywhere from 12 to 15% IRRs. So with prices increasing, yes, we can deliver on the expectation. The goal is obviously, again, to over deliver. But the way Vive underwrites our deals is we go in with the ultra conservative mindset. So as an example, our last deal, we have one deal down the street from it where we're getting over $300 a unit in premiums on unrenovated units. And on this deal, we underwrote to $300 premium on renovated units. So we know we probably are going to be able to do better than that. We've only owned it for 5 weeks at this point, so it's still we're still kind of easing into the transition, but we likely will be able to over deliver on that. And so, yes, I do think we can meet our expectations. Now, if pricing is too high and our return projections are just lower than what our investors will accept, we don't go into the deal. We don't overpay for our deals. That's what I was saying earlier is we're very disciplined. So we will walk away from a deal or we won't do a deal at all if the pricing doesn't make sense for our returns to investors.
Wow, that's such a perfect answer to a great question from Miller. Hey, on the topic of market trends, what are some current underwriting trends that you're seeing right now in your markets? And which markets are those, by the way? So people who have deals in these markets, feel free to reach out to Veena Jetti. Right here in the comments or after the show. So.
Yes, definitely. So our focus is in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona. So pretty much anywhere everybody else is investing, we're also investing in those markets.
Awesome. And what kind of trends are you seeing in those markets?
Yeah, so from an underwriting perspective, we're not really following the market trends because we're seeing massive rent growth. We're seeing massive premiums. And like I mentioned earlier, we are underwriting kind of to a lower standard than that because we want to have some wiggle room. On our assets, we have about $100,000 as our average income for the area. So we're in those slightly nicer areas. Some of the things that I'm seeing on deals that I'm looking at potentially passively investing into that we make it a point not to do is including a refinance or a capital event in the underwriting assumptions. So you're not going to see us go from like 6% cash on cash to 12% in year 2 or year 3 because we don't plan for a capital event. To me, that's something that is a little bit beyond my risk tolerance to underwrite for that, because if you don't refinance at that time, it really can hit your IRR and your total return to investors. So we don't underwrite for that. We also are seeing that rents have been growing well above what the projections have been. We do utilize AI technology in our underwriting. So we pay for data to be able to predict out with some level of accuracy what the market trends are going to do. So for example, if we see a 3% rent growth, we might use 2% in our underwriting. Or if we see like 7%, which we've been seeing on some of these assets, we might use 4%. So we like to use that as a benchmark and then kind of take it down a little bit. So those are some of the big trends that I've been seeing recently. Also, with regards to financing and leverage, I'm starting to see more and more investors leverage up to like 85%. Sometimes they're getting a little bit higher than that with private money. That really concerns me. I was in the market during the last crash and I remember it very well. So it definitely concerns me to see assets that are over levered, especially when you have investor capital in them. And then also just not underwriting to the potential for a cap rate expansion. That's the other big trend I'm seeing that we don't do. So we always underwrite to an expansion on caps. Caps have come down and I think they might continue to compress at least through 2022, which is great, but we can't assume that it can't go down forever. So we can't assume that. So we assume an expansion. I would say like 7 basis points per planned year of hold is pretty conservative average, especially if you're in these very high growth metroplexes. So 7 basis points is usually kind of the baseline of what we'll use. Our last deal we underwrote for 80 basis points over 5 years. So we went, almost 12 or 13 on our increase.
Whoa.
So
you have so many things that I want to unpack there, but we also have questions from the audience. So, but real quick, AI, whoa, you're using tech to help you out with your investing too. That's just super interesting. I don't know if you want to go into that or the next questions, but I'm just curious. How did you decide, and when was that?
Yeah, so we started using AI maybe about like a year-ish ago, a little over a year ago. I'm actually like I geek out on tech and these like spreadsheets and stuff, even though I'm like the least tech savvy person I know. So if you ask me how to like set your email up or something, no, I cannot do that. But I enjoy technology, and I think that the possibilities of technology are very advantageous, especially when we're putting together pro formas, because ultimately we're kind of guessing about what we think is going to happen, and it doesn't mean that it's actually going to happen that way. And so when we can utilize AI to predict out based on historical trends and millions of data points, it gives us a lot more accurate information. And so that's why I like to use AI in our business models.
Super cool. Thank you for answering that. Hey, we have a question from Cecilia in the audience on LinkedIn, live on LinkedIn. What would you say, Veena, is the most valuable lesson that you have learned, and how did you learn it?
Oh, okay. Well, I've learned like a lot of really valuable lessons over time. I would say I'll give you 2. So the first one is always be prepared for the unexpected to happen, no matter how good of an operator you are, no matter how on top of it you are and how much time, energy, effort you put in. There's always something that is not going to go according to plan. So expect the unexpected. I learned that when every single deal I've done to date has always had something surprising come up. And we've had to learn how to pivot around it and solve those problems. And I think the second lesson is in having really great partnerships. So we look for partners that are aligned with our vision and where we don't have to negotiate our investor first mentality, because they share that synergy and they share that the ethos of the deal being investor facing. And so I think that is really critical in a partnership. Again, that's something that kind of comes with experience. So make sure when you are going into those partnerships that you do have a good exit plan, tiebreaker solution plan before you get to an issue where you might need those. So always plan all of your partnerships and talk about the hard stuff up front.
That's fantastic and great lessons to learn. And wait, we have more questions from the audience too. Hey, by the way, we're halfway into the interview already, so I would like to invite you all for asking questions because you have this saying, I've heard it so many times. You've probably also been to conferences where they say it, closed mouth does not get fed. We don't know where you are, what you want, unless you ask for it. So please do share with us where you're at, what you're looking for, and how we can help you. So yeah, with that said, another question here from the audience is, how many deals do you underwrite in order to find one right now?
Hundreds of deals. I feel like it's a million, but I would say in today's market, we probably are saying no to about 300 to 400 deals before we're saying yes to one. So
that's a lot. Holy cow.
Yes.
We have a follow-up question with, do you bid on market listed properties or off market properties? If both, what is the ratio right now?
Yeah, so we do bid on both. We're agnostic to where the source of it is. If someone brings us an off-market property, we love that because theoretically there's less competition. Right now, all of the deals we've been closing have been on market. A part of that is because the market is just so hot. A lot of investors want to take it full cycle and increase competition. I do think that there's something to be said this quarter about trying to maybe soft market some deals off market and kind of see what happens and see if you can bid up pricing as a seller, bid up pricing when it's an off market opportunity. Sometimes investors are willing to pay a little bit more knowing that they have a good shot of getting the deal. So I would say, both, and it really depends. As far as the ratio goes, as of right now, 100% are on market. But I would gladly bid on off-market deals too. I'm agnostic to where they came from.
That's super cool. So. We have way more questions. Before those questions, I would like to ask another one, if I may. What should a new investor ask their deal sponsors? We're talking on the topic of building these relationships with operators. What are some good questions that you would recommend?
So first and foremost, I always like to understand who the actual sponsor is, who makes decisions. So am I answering to you or is it someone else that's answering to you? That's what I would want to know as the LP. So which sponsor is doing what, who is operating. I personally get a little bit concerned with having too many cooks in the kitchen when there's like 20 sponsors on the same deal. So I ask a lot of questions around that. What happens if there's a tie? Who breaks it? How does it break? Is there a process for that? I always like to know if sponsors are investing their own capital into the deal. If they're investing into the deal, are they investing alongside investors or are they investing in a different share class? Are they getting GP equity that's somehow treated differently? I also like to ask, are the sponsors that we invest into, why do they think that this underwriting is conservative? Give me some examples. I look at the pro forma numbers pretty in detail. I like to understand, are you guys going to be operating? And this is a little bit the hazards of the job because I can look at a T12 pretty quickly and know and see where like, okay, wait, this doesn't quite make sense. Your payroll budget is at $200 a door. That no way. It's got to be, $1,400 is a conservative amount. I know that from operating, but a passive investor may not know that. So really listening to the business plan of the why, like why this asset? Why do you think you can do this? What are the metrics you're using to measure that? And then obviously like asking about background, track record are all important as well. And then just really understanding who you are as an investor and knowing that your deal sponsor's investment criteria aligns with that.
For everybody who just heard that may have been like drinking from a fire hose. So please watch the recording afterwards. I mean, this is all recorded today. So we have more questions. And
Let's do it.
wow, that was value bombs. You're just pouring value today. Holy cow! Thank you so much,
Good.
Veena.
I'm glad
We have we have a question here from our most active attendant today, Cecilia. Third time. Which book or books have been the most, or have been the most? No, wait. Which book or books have given you the most actionable steps to implement in your own work life?
Yeah, so I think I'm one of the like black sheep in this industry where I don't like read a lot of apartment investing books in general or real estate books in general. I actually like to read more about strategically running a business. So I think that if anybody has not read The Millionaire Next Door, that was like the first finance book that I read, and I think it just gave me a really solid foundation. I actually hated it the first time I read it because my parents made me read it when I was 14, and I was like, this is boring. Who cares about this? Now I care a lot about it. So I reread it every now and then. So I really like that book. I also negotiate our PSAs often, our purchase and sales agreements often. I like to read books on negotiating. So I don't know if you've read Chris Voss's Never Split the Difference. I think it's a phenomenal book. I'm such a fan of his. I just think he's so wonderful and he's smart, and I love that book. I read that. One of my mentors recently sent me a book called Vivid Vision, where you basically go through and it really helps you create a timeline and a goal and a plan for the company so that everybody in the company has a cohesive vision. And so that's another book I would recommend. And then I also like to read more like factual data books, which sounds so boring, but like Malcolm Gladwell, he has some really great books that talk about like trusting your gut instinct, for example. So those are books I'd like to read. I'm not a big like real estate reading person. I don't know.
Blink is the book that you just mentioned by
Blink. Yep, Blink. That's the one.
Outliers. Also,
I just read Outliers again. It was great. I love that book. I'm actually about to start reading What It Takes by Steve Schwartzman, who started Blackstone.
Wow.
Yes.
Definitely writing notes here when I go back to the recording.
While you're at it, Am I Being Too Subtle? That's on my list too. Sam Zell wrote that.
Yeah. Hey, I don't know. Have your paths crossed in the real estate space?
I haven't yet. I can only hope one day they do.
I don't know. That was just a spur of the moment kind of question because I mean, yeah, he's also.
They do one day. They have not yet. And to be fair, I've also been like locked in my house for the last few years. So.
Yeah, unfortunately. Hey, we have a lot of questions from the audience here, and okay, I don't know if we're gonna have enough time for all of them, but keep messaging in the chat because this is great. We have a question from Rakim Bey on LinkedIn Live. Within the context of real estate deal, how high does cap rate rank among overall metrics in terms of importance?
Not as high as it does for LP investors for me. I know LP investors, a lot of times they will read like a blog or they'll read some book and then they just really focus on cap rate. It's one of many metrics for me. But the problem with relying on a cap rate too much is when you're acquiring an asset, you might acquire an asset at a 3.5 cap. But if you can operate it, like maybe you can make an immediate change and operate at a 4.5 cap or a 5 cap or a 6 cap or higher, then the 3.5 cap that you entered, yes, you're paying a little bit of a premium, but you also are able to realize the operating cap at a higher amount. And then if you can exit, like we entered a deal last year that was at a 4.7 cap. Today, the cap rates are under 3.5, 3.25. So cap rates matter in the context of the deal, but it's not a focus metric for us. I care a whole lot more about what the opportunity is on the asset and then what the IRR is. So we're very IRR focused. Our investors like the blend of IRR and cash on cash. So we do look for some component of cash on cash. But if it were up to me, I would look at IRR as my main metric as a sponsor.
That's yeah. We have another question, a follow-up question. It says LinkedIn user. So, oh, by the way, if you're new to the whole live scene, your privacy settings, you can allow for your image and your name to be shown if you want. If you want to stay private, that's also okay. That's just a FYI for our audience. So we have a question from the audience on LinkedIn Live. When you underwrite hundreds of deals, how do you do it effectively? Is it automated or manual? Could you explain the process, what tools, automation, etc., to make it consistent deal flow?
Yeah, so we're very, very rigid buyers. So we have a buy box that we do not deviate from. So what happens, like our overall acquisition process, right? The first thing that happens is we get a deal, we look at it for a few specific things that will rule it out right away. And most deals will get ruled out with this initial, it's not even like a back of the envelope analysis. It's like very high level. So we look at year of construction, we look at the market it's in, we look at the size of the deal, we look at the opportunity, if it's a value add opportunity or not. If it passes that, then we go to the next like light research phase, I like to say, where this isn't still not really back of the envelope, but then we start pulling metrics on the area. We start looking at the demographics. We start looking at current rents and where the rents can go. We start looking at if we have internal data points, we look at those immediately. So for example, our last Atlanta deal, we benchmarked to our own deals in that market. So that's like the next round of underwriting, if you will. And then after that, we do our back of the envelope. So the back of the envelope, we have to see within range of what our ultimate metrics are, but it's a very rough guess. So we don't necessarily know what the exact premium is going to be. We don't know if we can add Amazon lockers. We don't know if we can charge $50 for parking. So we're kind of taking like a little bit of a guess on it. But if that comes out kind of close to what we're looking for, then we actually underwrite the deal and do the first pass of underwriting. If we still have green lights all the way up to here, then we usually will schedule a property tour and we'll walk the asset and then tweak the underwriting again. Simultaneously to that, we actually do all of our comp shopping. So we do not rely on like CoStar or Axio or any of those to be accurate. It's like trust but verify. So our team actually will call each asset and will verify competitor rents, what 2 bedrooms are going for, whether they're renovated or not. So we do all of our own due diligence in-house for that aspect of underwriting. And then from there, we start getting debt quotes in place. Our debt quotes then get plugged in and we continue to fine tune our underwriting. And when we're in the offer stage, we'll continue to fine tune it through there too. So we know what our top dollar we can end up paying for the asset is. And a lot of times we're not winning the asset based on pricing. We're winning on terms more than anything.
That's a rigorous process. You're not kidding when you say that you're very conservative in your underwriting. It's a rigorous process, and thank you so much for I don't know if the LinkedIn user is still here, but yeah, feel free to let us know your thoughts on that response, because holy cow, I learned a lot. We have several more questions, and before then, I would sponsor for the show again. And one second, please. So capitalracesclub.com. Please go to capitalracesclub.com for more. Today's event is sponsored by the GOB network, where you can find passive and active connectors that you can connect and build relationship with. That is on gobnetwork.com. All right. Thank you so much. And who are asking questions here. So let's get to them. Wait, before that, may I ask,
Yes.
what is your favorite part about real estate? What, or you already said that the time it allows you and your decisions, but
Yeah.
is there anything else that you would like to
On
share?
the business side, my favorite aspect of doing a deal is absolutely 100% investor relations and interactions, because I'm an extrovert, so I like to get to know my investors. When I travel. I try to meet any investors that are in that area every time I go. Even on vacation, I try to meet up with them, even for like a beer or coffee or something. I try to make that time so that I really get to know them. So that's the part that's the most enjoyable to me.
That's so cool. And I have a couple of follow-up questions along those lines because I know, or I've studied you, so you care a lot about giving back and the philanthropic side of your I just please share with our audience today that what got you started in that and what charities or what organizations are you really rooting for and working with right now?
Yeah, so my parents actually raised us like this, they always raised us that to know that what we had a lot. We had more than most people do in this world. And so they always exposed us to charitable causes. Like we'd go to India every year and they'd take us to the orphanage. So we knew that not all kids had clothes and food and parents even. And so my parents were really deliberate about that. And that's something that I want to pass on to my kids as well. But for me, the philanthropic component is really, we we had some amount of luck and hard work, and we've had a lot of privileges. And I think that it is important to help each other out, because at the end of the day, like, that's what makes life tolerable, is having other people that are happy and healthy and safe around you. And we live in society, and as much as I'd like to think it's only my family, it's not. If another mom can't feed her kids, that's a problem for all of us. And so I feel very passionate about helping other people, and we have enough to be able to do that. And so we're in a very lucky position. And it could be any one of us, right? Like, I might need help tomorrow, and who knows? And so I think it's really important that we don't forget that no matter what. And so as far as charities I like, so we actually recently made a change internally that's kind of in this line. Actually, just last week we made this change. So usually when we close a deal, we would do some kind of small investor gift. And historically, I've done a gift basket from, like, with stuff from that city. So for Atlanta, we'd put like Coca-Cola, peanuts, peach jam, and like pecans or whatever. And which is fine, it's nice. But recently, the change we made, so for our last acquisition, instead of doing an investor gift, what we did was we're going to do a charitable donation in the investors' names. And we put forward 3 different charities that our investors can all vote on. And then we're going to let our investors pick where the money goes. So one of them is like a local food bank to the property, so it's in that area. One is ripmedicaldebt.org. I love that organization. They wipe out medical debt, which is a huge issue here in the States. And then I think the last one, I can't remember what the third one we had put on there. I think it was water.org, which they build wells. They give loans to poor areas to build wells so that they can have water supplies, because part of the problem is in a lot of these countries, when there's no water, they send young girls to go and get water from the well, which could be, a 2-3 hour walk each way. So young girls are missing out on the opportunity to get educated and go to school. And so these cities, by creating those irrigation pathways, they now can educate their young girls, which we know when girls are educated, it decreases the amount of teen pregnancy, it decreases poverty rates, increases literacy. So there's like a whole domino effect beyond that. And I think the last one in that same vein that is really important to us is kiva.org. So it's a micro lending site. We do a lot of micro lending. So whenever we have like a birthday or something, we'll put some money into our Kiva account. I have like a lending team, so we all lend together, and we try to fund women's businesses specifically, so that they can support their families. And so that's kind of one of the ones I like. It's a loan, so it teaches them how to operate a business, and it is sustainable for a long term. And then when they give it back to us, we don't ever withdraw the money. We just re-lend it out.
Technical difficulties. I was trying to get to the mute button. Yeah, that's so many organizations, and you really give back, and your investors get to be part of it too, which is at least for me, I feel super, super cool. I mean, not cool, but I feel so inspired that wow, this is possible thanks to what you're doing and the organizations you're working with, water.org, kiva.org, and I've looked them up and they're
Yeah.
doing fantastic things in the world and you get to be part of it. And thank you so much for sharing that. We have more questions from the audience, and hey, before we close, I would like to share with people how to connect with you,
Hmm.
or how they can connect with you. So I added here a banner. That's correct, right? Vive
Yes.
Fun,
Yes.
Veena.
Yes.
Beautiful. So
Fivefunds.com. If
yeah,
you go to fivefunds.com, you can actually log into my portal.
perfect. So yeah, definitely connect with Veena. Also here on LinkedIn, you can connect with her. Just click on her name. There you go. Then you're
Yes.
connected or follow and send messages. If you're interested in the mastermind that you had earlier, let's bring that link up. It was here earlier. Um, so many comments today. Holy cow! Going through them. Multifamily
There you go.
Monopoly Mastermind. If you go
Yes.
to that one, you can join the Multifamily Monopoly Mastermind.com with Veena and also with Alvin Hope Johnson, who are both extraordinary operators in the real estate space. So definitely connect with them. And yeah, back to the. Yeah,
Oh,
this is live, so that's I can't
I
edit that
know.
right.
Are you in a tunnel?
No, we live close by a road, and
Ah,
sometimes they have muscle cars outside here. One second, please. So we have a question from Robert Argona. He asks you, will Viva funds accept only accredited investors on your deals?
yep. So right now we do raise under a 506c, so we do only accept accredited investors, and we do require third-party verification per SEC guidelines. So as of right now, yes. It doesn't mean that we wouldn't do a 506b in the future. We just haven't, and we don't have any plans to as of right now.
That's super cool. He also added, "Nice to meet you and great job sharing your knowledge in the field." Hey,
Thank you,
super,
Robert. It's
super
nice to
good.
meet you as well.
Yeah. Any more questions from the audience? Feel free to pop them in. We're still going for a couple of more minutes. I have a follow-up question on the philanthropic side. How did you get started with it? When did you decide that, hey, now is the time to start?
Gosh. I just think it was always part of our childhood. My mom is the one who really was the driver of that, and both of my parents always encouraged us to volunteer. So even when we were in grade school, we always had to either be working at a job or volunteering, and so a lot of times we would just volunteer. My mom right now is even very, very active in various charitable organizations, and so and my sister too. So all of us kind of just have that in us to do that. Before we started letting investors choose the charitable cause, what we would do is every time we closed a deal, we would pick a charity. And usually I'd try to pick something that was central to whatever was happening in our lives at the moment or something that was close to us at that moment. And then I would invite all of the lenders and the vendors, everybody that basically worked on the deal or made money on the deal to donate alongside of us because we would do a charitable donation. And then now, and our passive investors are getting an opportunity to participate in where the funds go. And then we also invite them to join us and make a donation. Even, $5 can make a huge difference.
That's such a. Oh, I wish more people saw the benefit, not just the benefit, but the more you give and the beautiful lives that you can create. And I mean,
Totally.
I would like to ask one last question about commercial real estate or real estate in general is who do you look up to? Because I know a lot in our audience look up to you. So who are some of the people that you look up to and got you started in real estate?
Yeah, so my mom, she is definitely somebody that I rely on. My dad too, because my dad, although he was not in real estate, he was in corporate America until he retired. Now he handles the real estate portfolio. But my parents have just been very hard workers. They were both immigrants. They came here with nothing, and for me, it is really important to remember that the whole reason they came here was to give my sister and I a better shot at life. And so it's really up to us to take those opportunities that have been created for us and maximize them. So that's who I look up to. And also, it's like having an unofficial board of directors built in that has your best interest at heart and that's never going to give you bad advice on purpose. So for me, having, those family connections, and then also, I look up to a lot of my peers in this space. So the people that I have connected with on Clubhouse, like you and Alvin and Brandon Rule, and, just a lot of different operators that I have met, because I think, what is it? Iron sharpens iron. Is that the metal, or is it like, it's iron, right? Is that the saying?
I have no idea.
Iron sharpens iron, or steel, some kind of metal sharpens the other metal. And I feel like that's what it is, because we all become better when we share this knowledge. And I think that it's very important to have good sponsors, because once an LP gets burned by one sponsor, it does not matter. They're never investing with you or with me or with anybody else. So I think it behooves us to help others practice at the highest level that they can. Oh, wait, we can't hear you.
There we go. Yeah, the mute button technical glitch. That's spot on, and I see a lot of collaboration, and it's so, I don't know, but I've never been in an industry where it's hey, I help you and we both win.
Yeah. Yeah.
That mentality is not that common in most industries. Like, hey,
Not.
you just said, if you get burned by another operator, that person, that investor is gone from the industry as a
Yeah.
whole. So
Mm-hmm.
yeah, definitely. I mean, it is important, very, very important. We have a question from Rakim. I think this is the last question from the audience for today. So, at what point in the deal do you know when to focus on price and when to focus on terms? That's a great
So
question, Sven.
this is actually a very good question. It really depends on where we are in the market cycle. So when we're in a buyer's market, you can really dictate the terms, and you can probably pay pricing that you're pretty comfortable with. In a competitive environment like it is today, you have to be getting to your top dollar. And when you know your top dollar isn't going to be enough to win the deal with like a slam dunk, you have to be looking to what terms can I put in there? And sometimes it's actually about the deal structure. So I'll give you an example, and I know we're running out of time, so tell me if I'm going over, but an example of
Please
how,
go ahead.
okay, how we've used terms. So we were buying a deal, this was a few years ago. It was a $52 million deal, give or take. And the understanding what the seller's sensitivity is can be huge to focusing on terms in the right way. So we had gone in, we made our offer. We were not the highest offer, but they wanted to work with us because they're like, okay, you're young. You guys maybe will transact with us more. You have a great reputation. Your references checked out. But the challenge was they had an issue with the tax treatment on the pricing, and they did not want to pay for the deed stamps and transfer tax, which was, I think it was like around maybe 300,000 on that deal. And so instead of going and offering to pay for that, what we did instead was we restructured our deal, and we offered the same price, but then we decreased it by the 300K or whatever amount it was. And so we offered like 51,725 or something. And we said, but in addition to that, we'll take care of the entire doc stamps and the deed to the property, the transfer tax, transfer tax. And so we said, we'll take care of all of that and you won't have to pay it. And we were awarded the deal because we understood where their sensitivities were and how we could restructure the deal. It didn't change the overall price that we paid for the asset, but what it did do was it changed the internal situation for the seller. And so that's how we won on those terms. Now our terms are fairly aggressive. We're closing in 21 days of due diligence and 21 days of financing. So 42 days, we have no extensions. We go hard day one with, just very minimal carve outs. So we have to do a lot of our due diligence before we go under contract.
That's insane. And holy cow, they're talking about 300,000 in a $51.75 million deal. It's not that, I mean, it is percentages and whatnot, but you're easier to work with, you win the deal, right?
Correct. Yeah. You want that reputation. You want your brokers to know that you are someone they want to work with. So always do what you say you're going to do. We, to date, knock on wood, have not retraded a deal. So try not to do that because, once you get a reputation, you can't change that.
Yeah. Hey, we're up on the hour. So thank you so much, Veena, for being here with us. And for everybody in the audience, feel free to reach out to Veena on vivefonds.com. Veena at vivefonds.com is her email. And you can reach. I don't know if we want to say the phone number.
Change it to info at Vive Funds because you'll much more likely get a response if it goes there.
Right. Okay. I'm going to edit that right now. Meanwhile, we can do this. Yeah. Go to capitalracesclub.com. Okay. I'm just kidding.
I like it.
Wait. Info. Already updated it. Now we have it. Right. Beautiful. So go to info at vivefonds.com. When you want to connect with her on email, you can connect with her on LinkedIn. You can connect with her on most apps.
Yes.
But easiest would be just to go to vivefonds.com. And wow, such an honor having you with us here today, Veena. Thank you so much for making time for this. I mean, we learned a lot today, and I'm super stoked to share this with our network here in Capital Races Club.
Thank you so much for having me. This is so much fun.
Talk to you soon, and we're gonna in closing, we're gonna shout out some of the audience that were very active today, and talk to you all on Tuesday. We have our next networking event, so be on the lookout. If you haven't followed us yet on YouTube, on Facebook, on LinkedIn, on Twitter, we're on all the apps. Okay, so just go to capitalracesclub.com to join us, and we'll see you next week. Talk to you soon.